Commercial subcontractors, you're pricing your work wrong and you probably don't even know it. In my career, I've submitted hundreds of millions of dollars worth in bids on commercial construction projects, and I made every pricing mistake you can possibly imagine. So, in this video, I'm going to give you a framework that will help you avoid the same mistakes I made and shortcut your way to big piles of money and more profitable jobs. My name is Aaron Fry, founder of Atlas Trade Partners, a firm where we partner and consult with specialty contractors to help them achieve all their goals doing commercial work. Our team has done well into the nine figures in commercial contracts across 10 different trades, and we're doing everything we can to continue to expand and help bring in the next generation of commercial subcontractors. If you're a lowball contractor, a residential only contractor, or anyone who's never submitted a formal bid to a GC, you might disagree with this framework, but that's okay. This is not for you, anyways. This framework is for subcontractors who are winning work but bleeding margin on the wrong jobs or losing jobs that they should be winning. This is not a linear process and it's different for every company, right? The purpose of this framework is for you to understand these four levers and how you can use them as a lens to view each bid opportunity. From that, you can develop a scorecard that you can use internally to assess your bid opportunities. Every opportunity goes through the same process, and that gives you the ability to standardize your bid strategy. This is essential because without quantifiable data, you can never build a predictable or profitable business. So let's get into it. The four levers are risk, relationship, reputation, and resources. We call them the four R's. Every bid opportunity that we see with our companies at Atlas gets scored on all four before a number ever goes onto a bid form. And I'm going to dive into each of these, provide you with some specific questions, diagnostic questions that you can ask, and give you the resources to build your own process and your own scorecard. But one thing before diving into that, there is one term that's important to define. We all need to get on the same page as to what price is or what your bid price is. If the definition of what your bid price is not clear, your reasoning and confidence behind that price is not going to be clear either. Some common ways I've heard bid price defined are cost plus markup, what the market will justify, or my personal favorite, whatever you think they'll say yes to. Now, none of these are logical, obviously, or repeatable. At Atlas, we define bid price as total cost times your target margin multiplied by a risk multiplier and a strategic multiplier. Now that we can all agree on this formula, let's dive into the framework that'll help you find out what your risk multiplier and your strategic multipliers should be. Have you ever taken on a job with a line item that you didn't fully understand? Think about it. Did you profit what you expected to profit on that job? And if you were to do that job again, would you charge more than what you did the first time? Great. This is an example of how risk and uncertainty work in this business. It's very easy in the bidding process to overlook some of these things and hope for the best in prospects of winning the job. Some diagnostic questions to evaluate your risk on a certain bid opportunity. Is there anything in the scope you're bidding that you've never done before? It may seem obvious, but it's important to quantify that on every job. Warren Buffett uses the model of a circle of competence. As a contractor, you need to have this clearly defined within your business. Whatever is inside your circle of competence is where you are profitable and it's predictable profit. So what you're going to do is look at that job and you're going to split the scope you're bidding into two piles, everything that fits inside your circle of competence and then everything that's outside of it. Those need to be treated very differently, and you're going to weigh those against each other. What is going to be predictable and profitable on this job for us versus what is unpredictable and needs to have a higher level of risk associated with it because of that unpredictability. Another good question is your scope a lot of one thing or a little bit of a lot of things? A good metaphor for this, I played basketball growing up. And there was a certain workout we would do for conditioning. It was usually given as punishment if you messed up because it's so brutal. But we call them ladders. And basically, what you would do is you would run on the basketball court. You would start at the baseline. You'd run to the free throw line, back to the baseline, up to the 3-point line, back to the baseline, half court, and so on. You'd make your way all the way down the court, and then you'd do it on your way back again. So end to end, down to the 3-point line, back, half court, back, 3-point, back, and repeat. And you do, I don't know, 5 ladders. And by the end of that, you're gassed, laying on the floor, hating your life. What this is trying to get across is the idea of momentum on a job. If your scope is made up of one thing, that's like running 400 yards. Like, you can get a sprint, have momentum that carries you, and you can power through. But if it's made up of a bunch of little things, it's going to feel like a ladder and be much more demanding on your business. It's going to require much more energy and resources to execute that job because you're going back and forth, starting, stopping. This can be with scheduling, scope, and any other special circumstances that the job might require. Last question on this to diagnose risk is it all self-performed work, or are you going to be carrying subs? Now, you might carry subs frequently. Drilling into this question, how familiar are you with the subs that you're going to be carrying? Are you going to have to look for new subs to execute the job? And how much of the work is going to be performed by subcontractors versus in-house crews if you have them? Now, lever number 2, relationships. The same scope of work should be worth very different money depending on the GC that you're bidding to. This might seem intuitive, it might not. But a few questions you can ask and layer are, is this your first time bidding with this GC, or do you have a history? What's your win rate with them if you do have a history? If it's someone you've worked with, is this a GC that you want to have more of, or is it one that you tolerate? Different general contractors have different billing schedules, processes, contracts, and it can be a completely different experience working with the small GC who you've done 50 projects with versus the big regional GC, and this is your first job with them. Also, considering everyone on the project team as part of that. So the architect, the owner, the developer, the general contractor. There can be strategy in building relationships beyond just the GC, especially if you have design capabilities. And maybe you could work with the architect on that job in the future and become part of their team writing the scope on future projects. The next diagnostic question when it comes to assessing relationships that I like to use, is understanding if the project is part of a larger development with potentially more work behind it. If it's phase 1 on a multi-phase project that's going to carry out over 10 years, that's very different than a one-off project, right? So factoring that in and understanding maybe there might be justification to negotiate and get our foot in the door so that we can then become the go-to on all the next phases because we already have familiarity with the job. To wrap up relationships, let's take a hypothetical project. Let's say it's a $300,000 bid, and first scenario, you're sending this in to an unknown general contractor. You've never worked with them before. This is a one-off job, and you've heard from other subcontractors that they tend to pay slow. Hold that in your mind. Number 2, this is a GC you know of, you've sent bids to before, you haven't worked with, and it's a one-off job. There's not much you've really heard about the GC. Next one. This is a GC that you've done a couple projects with, and you know this is potentially going to be a multi-phase project. And if you do a really good job, it sounds like the GC is going to be going after future work on the development as well. And the last one, let's say this is a GC that you've worked with for 10 years. The project has got 8 phases. It's fully funded, and they've already let you know you're the only sub that they've asked to bid the scope. It's pretty obvious which one of these scenarios you would pick if you had to pick one of them. The last one makes everything else look absurd. So bucketing these different types of scenarios and elements within relationships into your scorecard and assign a value to each of those so that when you're assessing relationships as a leverage point on your jobs, you can have a clear value and understanding of what this project offers you. Moving on to lever number 3, reputation. Your portfolio of work is a sales asset, and every job that you take is either building it or diluting it. Now, this lever works much more in the positive direction than in the negative. I do think as a subcontractor, you can do a lot of jobs without necessarily worrying about your reputation being tied to it, doing jobs that you don't really care about, right? Not every single job needs to be a marquee project, and doing a small TI on a elementary school isn't going to damage your reputation. So a couple of diagnostic questions related to that. Is this the type of work I want to be known for? You can ask yourself that on every job and score it 1 out of 10. If every single job was this job, how impactful would that be to our brand? And another question, what's the visibility upside? Could this potentially be a marquee project? Right now, there's a Hard Rock Hotel being built in Las Vegas. It's shaped like a guitar. It's freaking awesome. If I were a subcontractor on that job, I would have that headlining my portfolio anytime I'm putting that in front of a general contractor, architect, or whoever. Side note, if you don't have a marketing deck with your portfolio of work and what makes you unique and differentiates you as a subcontractor, build it, please. So, a good way to reframe a marquee job that you're very excited about in going after, if you were to take that on at a reduced margin, you're not giving a discount. You are front loading marketing spend. You're prepaying marketing spend to win the job. And along with that spend, you're going to get a massive tower of evidence for what you do and something tangible and physical that you can carry forever. So there's a lot of value in winning marquee projects. They do a ton for your reputation, especially as you're growing your business and expanding into new territories and building new relationships. Having those marquee projects is going to give you instant credibility. So, our last and fourth point in this framework, resources. This one is the invisible hand that keeps a lot of subcontractors stuck. And it's the most overlooked element in taking on new commercial projects, especially large ones. So, let's dive into it. Every job that you take on also represents a job or multiple jobs that you don't take on. You can't do infinite work. So it's important to allocate your resources very wisely, especially when it comes to very large jobs that could be, depending on your trade, multi year contracts that you're fulfilling on. Every single contract that you sign is going to represent a certain percentage of what your business is capable of doing over a certain period of time. To visualize this, let's say you've got a contract coming up. It's going to take you 6 months to fulfill on. And I'll do this to keep the numbers easy. During those 6 months, it's going to take up 50% of your bandwidth. So this is a massive job. If your target margin, let's say your gross profit needs to be 40% to keep your business healthy and operating, if you take that one on at a discount, you're trading 6 months, 50%. That's 25% of your fulfillment capacity throughout the year at a discount. When you do that, it can decimate your bottom line and very quickly put you in a position of keeping the lights on with the work rather than profiting and growing your business. Now, if the project makes it worth it to you for you to do that, then go for it. That's why it's important to score each of these different levers and take full understanding of the context of the job before you just throw a number at it. A few diagnostic questions you can ask yourself in assessing the resources that a job is going to take. I already talked about what percentage of my fulfillment capacity is this going to consume and for how long. What else is likely to come across my desk during that window? If you have a seasonal type of trade, let's say you do exteriors or roofing, and there's always a big rush before the winter. If you have a really large job that comes in and is going to eat up a lot of your capacity over that season, it's important to understand what you're trading off, because a lot of times on those high urgency type of requests, there's a lot of room for margin on the upside that you can take because you know it's worth it to them to pay more and get it done faster. And also drill down on your resources in understanding what those are, whether it's manpower, how logistically demanding it is, what is the distance that this project is from your nearest office that you're going to be servicing it from. What does that mean in your cost per mobilization? And what other special circumstances are there surrounding the job that are going to be demanding of your resources, time, attention, and capabilities? A clear operating rule for this lever is, if this job is going to require more resources than normal, target margin or higher, no exceptions. And if fewer resources than normal, you've earned the right to price lower if the rest of the scorecard supports it. Okay, so those are the 4 R's for pricing commercial bids: risk, relationship, reputation, and resources. You should be able to ask yourself relevant questions related to each of those and build out your own scorecard and process that will allow you to standardize and gather quantifiable data from the bid opportunities you receive and really make informed decisions on what work you should take on and how to appropriately price that work in a way that allows you to continue to grow your business and you don't become resentful of the jobs you were excited to win a year ago. If we zoom out, as a specialty contractor, your business is the sum of jobs that you have said yes to. So if you're bidding everything and anything and just throwing out pricing based on your gut feeling, you're allowing a lack of discipline to steer your ship and decide where your company goes and what it becomes. This scorecard isn't a pricing tool. Really, it's a filter for what your company becomes and allows you to take complete ownership of that and build the company that you want. So, with that, take these tools, make a ton of money. If you have success with it, let me know. And last but not least, be sure to like and subscribe. Bye.